In this video, I want to talk about how to assess the economic factors driving currency exchange rates. What factors actually have uh, direct impacts on the currency exchange rates? You are a forex trader. What factors do you consider? What do you really look into that could have an impact on the value of the currencies you are trading? So currency exchange rates are influenced by a variety of economic factors that can shape the nature of demand and supply, for different currencies. Understanding these factors can help investors and traders make informed decisions. So here is how to assess the key economic elements, driving currency exchange rate. We want to look at these factors one by one. Number one is interest rates. Interest rates. So interest rates set by central banks are often, one of the most important factors influencing currency exchange rates. Higher interest rate generally leads to currency appreciation as they attract foreign investments in assets denominated in the country. Then conversely, lower interest rates often cause currency depreciation due to reduced investment demand. Usually, when it comes to movement of economic assets, they are driven by demand and supply. Number two is inflation rate. Inflation rate. Inflation reflects the rate at which the general price level of goods and services are rising. So countries with low inflation rates tend to have appreciating currencies because their purchasing power remains strong. So the stronger the purchasing power of consumers in that particular country, the higher the value of its currencies. On the other hand, countries with high inflation experience a depreciation in their currencies due to the purchasing power, of their currency, getting eroded. Number three is economic growth. Economic growth. So economic performance, measured by GDP growth, impacts currency exchange rates. A strong economy typically leads to currency appreciation as growth attracts foreign investment. The more foreign investors come into the country, it strengthens the country's domestic currency. And so conversely, slow or negative economic growth can lead to currency depreciations, as investor confidence diminishes. These how sentiments even comes into when it comes to forex trading. Number four is trade balances. Trade balances. The trade balance, which are measures the difference between export and imports, directly affect currency values. A trade surplus, that's where exports is more than imports, where exports is greater than imports, increases demand for the country's currency, leading to appreciation. In contrast, a trade deficit, can weaken a currency due to increased demand for foreign currencies to pay for imports. When importers, when they demand foreign currencies at a higher rate, at a higher degree to be able to import into the country, discover that it will affect the country's currency, domestic currency. Number five is foreign exchange reserve and intervention. Foreign exchange reserve and intervention. Central banks hold foreign exchange reserves to manage currency value. Most countries have foreign currency reserves in their tilts. So some central banks actively intervene in the forex market to stabilize or influence the exchange rate. For example, countries may peg their currency to another or engage in market intervention to maintain a stable exchange rate. So the central bank does that. It regulates the value of its domestic currency against foreign currencies. Number six is political stability and economic policies. Political stabilities and economic policies. Political events and government policies are key factors in determining currency values. Political stability and and sound economic policies tend to strengthen a country, or tend to strengthen a country's currency, while political instability can lead to a weakened or devalued currency. And so fiscal policies such as taxation and government spending, and monetary policies like central bank actions, also influence inflation and interest rates affecting currency values. You discover that the central bank can employ monetary policies to influence currency value. Number 7 is commodity price. Please subscribe to this channel if you've not done that. It will give me the encouragement I need to keep on bringing contents of this nature to you. Number 7 here is commodity prices. Commodity prices. For countries that are major producers, or exporters of commodities like crude oil, like gold, and other agricultural produce, changes in commodity prices can significantly affect their currency. If there's a change in global price for crude oil, a country like mine, Nigeria, will then really feel the impact. It will certainly affect our currency. And so if oil is being sold at a higher price, it will equally affect our currency positively. And so rising consumer commodity prices tend to strengthen the currencies of exporting countries, while falling commodity prices can weaken them due to reduced export revenue. That particular impact on rising or reduce commodity prices. Number 8 is market sentiment and speculation. This is where behavioral finance comes in. Market sentiment, that's investor sentiments, could have a huge impact in these regards. So currency markets are also influenced by investor sentiment and speculative activities. During time of global uncertainty, investors often move capital to safe haven currencies like the US dollar or the Swiss francs or the British pounds. So speculators react to economic data, central bank decisions, or geopolitical events influencing short-term currency movements. Number 9 is global events and crisis situations. Global events and crises and situations. Global events such as financial crisis, wars, pandemic, or natural disasters can impact currency values. So during crisis, investors typically seek safe haven currencies, leading to a shift in currency value. Events like the 2008 global financial crisis, the housing bubble as at that time, or events like COVID-19 actually caused widespread currency volatility due to economic disruption, experienced, in countries worldwide. And in conclusion, to assess the economic factors driving currency exchange rates, consider the broader economic environment, including interest rates, inflation, economic growth, trade balances, as well as political stability. So you want to go into forex trading. These are factors you should learn to take into consideration: interest rate, inflation rates, economic growth, trade balances, and all these factors, commodity prices, and global events, political stabilities, we all come together to affect the value of the currency in question.